Management Accounting C370. In this video, we will be looking at Unit 1 Management Accounting Context and Performance Measurement, and we will be mainly stressing on the divisional performance measures. Considering about the divisional performance measures, when it comes to divisional performance measures, they include both financial and non-financial measures. When it comes to the financial measures, first of all, we'll be looking at the absolute profit, and this is where the profit level achieved by a division in any particular period is compared with the expected performance level. The key benefits of using this as a divisional performance measure is that it's very easy to use and it's based on financial reports. However, the drawback is that it is not a good measure because it ignores the investment in the business or how long-term profits can be affected by short-term decisions. For example, reducing research, maintenance, etc. could be done as a result of this. Secondly, we have the financial measure of return on investment, or ROI, which is the rate of return achieved on the capital employed or invested. It is calculated by dividing the operating profit by the capital employed and multiplying it by 100. This was developed by the DuPont Powder Company, and it provides several benefits. First of all, the relative success of divisions and managers can be judged by the return on investment. So with the divisionalized business, each division must contribute to the overall business return on investment. So one way in which the divisional return on investment can be evaluated is by comparing the divisional ROI with the ROI calculated from the company's financial statements. And considering about the problems of using the ROI is that we are unable to make a decision on the relative performance without knowing the cost of capital, and sometimes we have to compare whether a high rate of return on a small capital investment is better or whether a lower return on a larger capital investment is better. And the alternative for this is residual income, where the profit that remains after being adjusted for the cost of capital is considered. When it comes to the cost of capital, it is the cost that an organization incurs to fund all of its investment, and it was developed by the General Electric Company, and the aim of managers in this case should be to maximize the residual income from the capital investments in their divisions. When it comes to the benefits of residual income, according to Solomon's 1965, a residual income target is preferred to a maximization objective because it takes into account the differential investments in divisions in absolute terms. And also Johnson and Kaplan 1987 argues that the residual income approach overcame one of the dysfunctional aspects of the return on investment measure, in which the managers could increase their reported return on investment by rejecting investments that yielded returns in excess of their firm's cost of capital, but that were below their current average return on investment. However, there are problems of using the residual income approach also. First of all, Solomon's 1965 points out that the residual income approach assumes that managers have the power to influence the amount of capital investment, which is not always the case. And in general, a main problem in evaluating the divisional performance in this way is the extent to which the managers can exercise control over investments and cost charged to their responsibility centers. So in this case, controllability becomes an important tool in the performance evaluation of business units. And considering about return on investment and residual income approaches, there are several common problems. The main common problem is that the calculation of capital investment, whether it should be based on total assets, net assets, non-current or current. And also when it comes to Solomon's 1965, he argues that the investment value should always be equal to the total assets with non-current asset values at cost controllable liabilities. And The return on investment will relate the controllable operating profit as a percentage of controllable investment according to Solomons, and also residual income would measure net residual income plus the actual interest expense against the total investment in the division. So, in using any such means of performance assessment, it is essential that managers of a business unit or division are only held accountable or responsible for those items that are within their control. So, purely financial measures are useful in understanding the performance, but they don't really provide a complete picture, and other factors are also critical to the success of the business. However, the managers tend to focus mostly on financial measures, mainly because it's easier to calculate. But actually, we got to consider both financial and non-financial measures, and this is why measures like balanced scorecard have come up. According to Atkinson et al. 2012, with the consideration of all of these things, companies continue to track financial results, but they also monitored with non-financial measures. And actually in balance scorecard they track the financial results with non-financial measures, and they consider whether they're building or destroying their capabilities with customers, processors, employees, and systems for future growth and profitability. According to the financial measures used in the balance scorecard, these are actually lagging indicators of the strategy because they report the financial impact of decisions made in the current and prior periods, whereas non-financial measures in the three other perspectives are considered as leading indicators because the improvement in these indicators lead to better financial performance uh, in the future and vice versa. Also, the financial and customer measures represent what the company wants to accomplish with its two most important external constituents, that is shareholders and customers. And the process perspective describes how the strategy will be executed, whereas learning and growth perspective describes how will the employees obtain the skills and knowledge to be able to improve the quality and cycle times of the company's production processes. Considering further about the balanced scorecard according to Haynes in 2017, balanced scorecard may be used at the division, department, or company level. And one main method that is used by organizations to combine financial and non-financial measures is this balanced scorecard, which is strongly linked to an organization strategy because an organization strategy, mission, and vision is the starting point for a balanced scorecard from which the four perspectives are derived. And considering about the development of the balanced scorecard, it was actually developed by Robert Kaplan, and it is often represented in a 2 by 2 grid where you consider the financial measures, internal business measures, the customer measures, and the learning and growth measures. So for organizations applying the balanced scorecard in practice, the four perspectives may be tailored to make them more relevant to the individual organization. And in many organizations that use balanced scorecards, the performance rules chosen reflect the organization's profile, mission, and specific objectives. Whereas Collier 2015 points out that the limitations of financial measures were identified by Johnson and Kaplan 1987, where they pointed out that managers discovered that profits could be earned not just by selling more or producing for less, but also by engaging in a variety of non-productive activities like exploiting accounting conventions, engaging in financial entrepreneurship, reducing discretionary expenditures, etc. And that short-term financial measures will have to be replaced by a variety of non-financial indicators that provide better targets and predictors for the firm's long-term profitability goals. Thereby, there have been many attempts at non-financial performance measurement as early as the tableau de bord that had been developed by sub-departments in French factories. Thus, various performance measures, which are non-financial, were introduced. For example, input measures like human, physical, or financial resources used. Then activity or process measures like number of hours worked, number of material issues, number of deliveries. Output measures like quantity of goods, sales revenue, efficiency measures like ratio of output to input, effectiveness measures like measures of output conforming to specified characteristics, maybe things like quality pass rate or on-time delivery. Then the impact measures, that is where how outcomes contribute to achieving organizational strategy like customer satisfaction is considered, and the investment measures like capital expenditure, distribution, channel expansion, etc. Of all of these, the balanced scorecard is the best known example of a more balanced approach to performance measurement than which was available from financial performance alone. So the balanced scorecard took as a starting point the goal to generate long-term economic value. This required other than financial measures as drivers of long-term performance and growth. Considering about the benefits and drawbacks of the balanced scorecard approach, according to Collier 2015, it provided the ability to link a company's long-term strategy with its short-term actions. So, meeting short-term financial targets should not constitute satisfactory performance when other measures indicate that the long-term strategy is either not working or not being implemented well. And also, it presents 4 different perspectives, and it complements the traditional financial indicators with measures of performance for customers, internal processes, learning, and growth. Not only that, the balanced scorecard translates a company's strategic objectives into a coherent set of performance measures with the customer, business processes, and learning and growth perspectives as lead indicators and financial indicators as lag indicators. So also these organizations develop performance measures linked to their strategy and competitive position. For example, when it comes to the performance measures, when it comes to customer perspective, we can use performance measures like market share, customer satisfaction, etc. Business perspective can be measured in terms of quality pass rate, on-time delivery, productivity, etc. Whereas learning and growth perspective can be measured using employee retention, motivation, investment in retaining, investment in training, and research and development expenditure, and also the new patent registrations. So thereby, the balanced scorecard is actually a simplification of the complexity of any business organization, its predictive model, and the competitive environment. So the notion of balance is a distinguishing feature of the balanced scorecard that organizations cannot maximize performance on all 4 perspectives simultaneously. However, optimum overall performance is the likely result of finding the right balance between performance as measured by all the 4 perspectives. And even strategy mapping was a development of the balanced scorecard approach, where the assumptions of the organization's predictive model is reflected and where a strategy map identifies the assumed cause-effect relationships. And when it comes to performance targets, these are developed for each of the elements in the strategy map, and financial resources are allocated to support the achievement of those targets. Nevertheless, review the monitoring and review of performance takes place by comparing actual performance against targets. And this is where performance needs to be improved. And the strategy mapping involves making resource allocations through changing budgets. And this approach is actually challenging the traditional budgeting view or traditional accounting view of fixed asset resource allocations for the year, because this is a logical extension of managing performance more flexibly, and this actually lies at the heart of the strategy mapping process. And when it comes to strategy mapping in a more closer way, strategy mapping is a continuous process through which the performance measures are used as a method of learning what works and what doesn't. So learning results in changes to the assumed cause-effect relationships and to perform measures and targets. When it comes to the relative importance of performance measures, so this is where learning results in changes to the assumed cause-effective relationships and to perform measures and targets. When it comes to the relative importance of performance measures, this is addressed to some extent in the balanced scorecard by the assumption of a hierarchical relationship between the 4 perspectives, where they identify that improving learning and growth will transform business processes, which will in turn lead to more satisfied customers and finally to financial performance. But Norreclit et al. 2008 have questioned whether such causal relationships actually exist, and we will be looking at it in detail in the next video. In our next video, we will be looking at the balanced scorecard approach in detail with respect to NORAC League 2000, where we consider about the performance evaluation using the balanced scorecard.